Now, investment properties. This is a target area of the tax office because in a recent audit, 90% of returns that included investment properties had some sort of error in them. Now, if there was a portion of the year where the home was used for personal use, say it's a beachfront investment property, then you may need to apportion your tax deductions between what was related to the business use or the work use and what was related to private use. You generally can't claim tax deductions for anything that has a private use. Now, it is okay if the property was vacant. You just must demonstrate that it was available for rent. So keep things like your rental listings as proof that the property was available for rent during a particular period of time. Now, another target area, if you own the investment property, say 50-50 with a spouse, the income and the expenses need to be split in the same proportion as the ownership percentages. For example, you can't apply all the tax deductions to one person who has a higher income in the joint ownership. It needs to be split in those ownership percentages. Now, some common tax deductions available for rental property. The first is interest on any mortgage, repairs. However, you generally can't claim a tax deduction for any repairs that occur in the first 12 months of buying a property, unless they generally result as damage from the tenant. The catch is if you're making an improvement to the property, you might not be able to claim a tax deduction for that straight away. It may need to be spread over a number of years. And other things like advertising, bank charges, body corporate fees, cleaning, council rates, electricity and gas, gardening, lawn mowing, in-house audio video service charges, insurance, land tax, legal expenses, lease costs, pest control, mortgage discharge expenses, property agent fees, quantity surveyors fees, security, stationery, postage, telephone, water charges, and lender's mortgage insurance, usually written off over the shorter term of the loan or 5 years, and travel expenses to inspect and maintain the property. And these can include meals and accommodation related to that travel. Now, there are 2 deductions available for depreciation on investment properties. The first is what's called capital works, which are like the structural improvements to the property. If you haven't been given this schedule by the person that you bought the investment property from, then it could be a good idea to find a quantity surveyor. You'll pay them a fee and they'll give you a depreciation schedule for that property that you can claim tax deductions for. And for things like hot water systems, depreciable assets, these are mainly available on new items, not on second-hand items. And the rules for this changed in 2017. So make sure you're only claiming a tax deduction on newly acquired depreciable assets. And some examples of depreciating assets in investment properties are things that can be separately identifiable. Things like floating timber floors, carpet, curtains, washing machine, fridges, hot water systems. And any depreciating asset that you bought that's below $300, you can claim an immediate tax deduction for that. If it's over $300, you normally have to depreciate that over a number of years. So make sure you keep all your records for this, your bank statements, your invoices, your listings, everything that will help you substantiate your tax deductions. And if you're listing your property on places like Airbnb and Stays, the tax office has data sharing agreements with these platforms. So make sure you do include your income and your deductions related to these investment properties. Now, the next video in the series can be found right here. Keep in mind, I'm not a licensed tax advisor. This video is for educational purposes only, based on publicly available information. I've just packaged that information in an easy, digestible way for you. See you in the next video.